background's in accountancy and tax. I built a practice from scratch, started in about 2009. In 2021, I sold a controlling stake in it to an EOT. So I'd heard a bit about it a few years before that. I've done it myself roughly 3 years ago, and now I help other smaller businesses do the same. So what is an employee ownership trust? I think the main thing you need to understand, it is a way of exiting your business. So that doesn't mean you can't work there anymore, but you do need to understand that it won't be your company anymore. So it does take a mind shift. To get most of the perks, you have to sell a controlling stake. So the EOT will control the company, and you cannot control the EOT, ergo you cannot control the trading company anymore. So there will be a lot of flexibility in what the founder does after the sale. Sometimes people will remain the full-time managing director. That's definitely an option. And you do get people who, you know, they haven't fallen out of love with their business at all. They don't want to go off and do other things. They love that business and want to keep growing it, but they just want to change the ownership structure to share perhaps both the responsibility, but also the reward of ownership. Equally, probably more commonly, people are doing it as a sort of retirement plan, that perhaps they're in their 60s and they just want to do other things with their life. So an EOT enables them to sell the business without needing to find a buyer and negotiate with them and go through the due diligence process. So a question a lot of people ask is, how much will they get for their business? And this is where it comes down to a combination of what you can get someone to sign off as an independent valuation and your own conscience. So that latter point might sound very odd, but you need to remember that you are effectively selling to the employees. They will not be putting their hands in their pockets, but they will be indirectly paying the amount you get based on their efforts, them continuing to generate profits, much of which will go to you. So I've heard a few founders say after selling that, you know, they realized partway through the process that the main party on the other side of the negotiating table was their own conscience, because the higher they try and justify the sale price, the longer the staff are going to have to work and pay most of the profits to the founder without it having to go to them. So what kind of figure do we tend to be looking at? I believe you had a talk about exits yesterday. So if any of you were in on that, and even if you weren't, you might be familiar with phrases like adjusted EBITDA, which is pretty much a posh word for profit. And we're looking at a multiple of normally 3 to 4 times adjusted EBITDA. So I know some of you, perhaps especially if you're maybe in the tech sector or somewhere else, you might be thinking, hold on, that sounds rubbish. I've heard I can get 5 times, 6 times, 10 times EBITDA. Perhaps, and I think it is worth saying, if your main focus is the most financially lucrative exit option for your business, an EOT probably will not be that. And I'd also say it should not be that, because if it is the most lucrative option, then basically you're making your employees pay more than anyone else was prepared to pay, which doesn't sound right to me. The other thing you need to understand is that because you'll be predominantly be paid from future profits of the business, it needs to be exciting for the staff. They need to be thinking, you know what, yes, we've got to pay a bit of the money to the founder for a while, but we can see the exciting light at the end of the tunnel where this will get juicy for us. If they're sitting there in a position where they're thinking, you know what, for the next 10 plus years, 90% of the profit's going to be going to the founder, you know what, this isn't worth it. And they'll quit and get a job elsewhere. And if a few of the senior staff do that, quite quickly you can find you've not got a business anymore, which means you've not got profits anymore, which means you as founder don't get paid. So I do think it's important that founders have what I would call reasonable expectations, modest expectations as to their sale price, because if they don't, there's a real risk it doesn't work. In terms of how you actually get paid, so key thing with EOTs, there is no external money coming in. So normally if you've got a trade buyer or you've got private equity, you've got someone with deep pockets saying, here's a big load of cash, we want to buy this business. Here, all of the money that you're going to get paid is going to come internally. It's going to come from the company profits. So what that can mean is that if you've been trading profitably for quite a while, but you've been quite frugal with your dividends, you've allowed a bit of a war chest to build up, probably for personal tax reasons, because you know taking out more dividends would sting you. Great, that can be a nice big day one payment for you as part of the EOT sale. So it's a whopping great amount. You can get tax-free. I'll come to the tax consequences a little bit more later on the day of sale. So that reduces the risk for you and obviously gives you a decent payment. Other than that, you're going to be looking at getting paid out of future profits. So this is where there'll be that conflict, where those profits for a certain period of time will be basically divided between you as the founder slash vendor and the employees. So obviously, in an ideal world, the profits rocket upwards. You can get paid a decent amount and there's plenty left for the staff. But if things are a bit more ropey or plod along, that's where there can be a bit of squabbles because there's not that much to go around. So in terms of the perks available, the tax perks are the ones that get the headlines. They're the ones that perhaps get things interesting or get people interested. So as long as you meet the criteria, which predominantly speaking is you must sell a controlling stake. The EOT has to gain control. It has to be a trading company. Profits need to be distributed equitably. I wouldn't be too worried about that. All that means is that when you come to do profit shares, just make sure you follow one of the set formula. So as long as you do that, you will not pay any capital gains tax on the sale. There is a clawback period for that, which if any of you are listening intently on the budget, has recently been increased quite significantly from give or take 2 years to give or take 5 years. What do I mean by that? I mean that potentially you meet all the criteria for an EOT sale to qualify, you do the sale, happy as Larry. 2-3 years after, something happens to the business, it changes significantly, perhaps the EOT no longer has a controlling stake. Be warned, your capital gains tax break is at risk. So what does that mean in practice? It means it's vital for you to, when doing the sale, make sure the business is stable, make sure that it carries in broadly the same vein that it was doing beforehand. So it's another area where it's a bit different to a trade sale, where with a trade sale, you may well have an earn out of sorts, but on the whole, once you sign on the dotted line and the buyer signed on the dotted line, from then on, it's pretty much their problem. With an EOT, it will be your problem for quite a while to come. So signing on the dotted line is really just the beginning. And the other key thing, which can be a bit complicated, is what's called the participator rule or participator ratio. Basically, it boils down to the number of shareholders relative to the number of employees. So the reason for this rule, the logic behind it is, imagine a hypothetical situation, a company that's got 4 siblings who own a company 25% each, and they've got 1 admin assistant who's just on the payroll. The argument there would be, well, if they sold to an employee ownership trust, nothing's changing in terms of the control of the business. 4 of the 5 people there already basically owned it anyway. So you're not really having a change there. So put simply, you need at least 5 employees for every 2 shareholders. So situations where this can cause a problem is either at the very smallest of businesses, or the slightly sadder situation where you've got a founder who's grown a business a little bit. They love the idea of employee ownership, so they started dishing out 5% to this employee, 10% to that employee, and then they look at doing an employee ownership trust. Oh, but hold on, half the staff here have got shares now. So if you're thinking about an EOT for 2, 3, 4 years down the line, do be a bit careful about handing shares to your staff before then, because you might find you've kind of screwed yourself up a bit there. I did just have a question coming through. I don't know whether there's any strong preference, whether I deal with them as I go along. Can you contract for the business to compensate in the event that is an issue? I should have made sure I read that at the time it was written. In the event that is an issue, I'm guessing, are we talking about if post-sale something changes that means that you fail to meet the criteria, Robin?
Yeah, you're giving up control at the time of sale. You have a period of time where the employees are now in control. They change the tenor of the business, exposing you to capital gains. Can you make it such that if they make changes to the business that expose you to capital gains, they then pay those capital gains?
I mean, part of the share purchase agreement will stress the importance of these key criteria and that they need to be met. More often than not, the founder will be one of the trustees. So I'll perhaps talk a little bit about trustees in the future. Mm-hmm. So again, I'll stress they cannot control the business, but they can still have a reasonable amount of power. Mm-hmm. And having said that, with the documents that we produce, if we were to assist, this may sound a bit of a fudge, but we would have it that at least 75% of the trustees need to agree to something significant like all the shares being sold, and there would only be 3 trustees. So it's sort of a coincidence, sort of not, that actually means you need all of them to agree. So if you're one of those 3, you can basically veto it. But we're a little bit careful about that because we need to make sure that the founder does not control. So there's a difference between being able to enforce your decision and being able to block something.
Yeah, directive power versus hold-up power, yeah. Okay.
Exactly that.
Thank you.
So in terms of downsides of an EOT, as I alluded to earlier, it should not be the most lucrative thing. And I think, you know, if there's one thing I fall out with founders most common about, or fallout's a strong phrase, is when they're saying to me, you know, my business is special. I had a mate who sold his business for 8 times EBITDA. And I say, well, lovely, but I'm not prepared to sign off that won't work here. So, you know, we do miss out on sales because of that. I think you can get a reasonable sale price. I don't want to pretend you have to give it away, far from it. But don't just go on the basis that you find the highest possible offer you think you might be able to get on the open market and then say, right, that's the price I'll then use in an EOT sale. And the other downsides, you will almost certainly be paid out over a longer period of time than your typical trade sale. I mean, I don't want to talk too much about trade sales because I think you had that yesterday, but you might expect something like 50% or 75% on day one with a trade sale. With an EOT sale, it'll be limited to how much they're seeing as excess cash in the company, which potentially will be zero. And if it is, you're going to expect probably at least 5 years, maybe up to 10 years for you to get paid out. So do bear that in mind. It's going to be a slower payback period for you. Just want to talk a little bit about the trustees. So this realistically will be a new concept for the business. The trustees effectively take on the role of the power side of being a shareholder. So I'm guessing most of the people in this room are probably a shareholder and a director of their own company. Sometimes the danger of that is it means you don't need to know what are you technically doing in your capacity as a director and what are you doing in your capacity as a shareholder, because it's just you making the decision either way. So with an EOT, that will be divided and that will become quite different. So the directors of the trading company really are no different to directors of any other trading company. They're in charge of the day-to-day running of the business. They're in charge of the strategy. What do we do next? You know, looking to see what else is going on and making those key decisions. The trustees effectively replace the power of the shareholders. So what does that mean? That means for occasional, infrequent, but massive decisions, the trustees will be brought in. So examples would be, as you know, someone wants to sell the business. Well, the trustees would effectively have the sign off of that, not the directors of the trading company. The trustees will also, something I would hope they would use extremely infrequently, but they have the power to kick out the directors. So that's really the ultimate sort of big red button power that they've got. So again, if you were to sell your business to an EOT and you wanted to remain full-time managing director, you can do so. But as I stressed at the beginning, there will be a mechanism where if collectively the staff wanted you out, they could get you out. In terms of who the trustees would be, so there are no laws on this other than one that recently came in the budget. Trustees have to be onshore, UK based, and the trust cannot be controlled by the exiting founders. So what we would tend to suggest is that you have 3. 1 is no good because if you just have 1, they have full control. 2 isn't really any good because if you have any binary decision, you've got deadlock if they can't agree. And if you give one of them, you know, the power to have the deciding vote, well, really, you've just given them control. So 3 is effectively the bare minimum. You can't have deadlock on a binary decision. Theoretically, you could if there were like 3 choices and each one wanted a different one, but that's pretty rare. So one of them would tend to be the exiting founder, and they would tend to have the right to remain on there until they've been paid off in full. Doesn't mean they have to be if they want to disappear off, if they trust the team completely or they've lost interest, but they can't be kicked out until they've been paid off in full. Second one would be an employee. And here we would stress it should not be a director of the trading company. It should not be, you know, the person who's been your right-hand man or woman in running that business. It should be someone, you know, a rank and file employee that's there to stand up for the metaphorical little guy. And the final one would be an independent trustee. So that might typically be a business coach of some kind or an accountant, someone like that who's external to the business but cares about it, perhaps has some skills that you might be otherwise missing in the trustee board or in the business more generally, so they can offer some wisdom and you know, help make good decisions be made. But the trustees do not, should not, and do not get involved in the day-to-day decision making. That's left to the directors of the trading company. So one other question we get asked a bit, with an EOT, as I alluded to, you have to sell a controlling stake, but you don't have to sell 100%. So potentially, if you currently own 100% of the company, you could sell 51% to an EOT, you could keep 49%, you tick all the boxes, great, happy days, nothing wrong with you doing that at all. But a few things that I would warn. 1, the tax perks that you get on that sale are only for the tax year that the EOT gets the controlling stake. What do I mean by that? I mean, if you sell 51% today, thinking, well, I'll sell the other 49% to the trust, gradually over the next 10 years, you can do that, but those future sales will be taxable. And also just be warned that the 51% has control. So 49% is a lot, but you don't really have very much power. So potentially if you're thinking, well, it's fine, I'll get 49% of the profits. Well, potentially the trust can engineer things so that staff salaries get increased, so there aren't really any profits. So I'm not saying don't keep any shares in your company, but I'm just thinking by handing over that control, you need to be aware that the shares that you keep perhaps aren't worth as much as you might otherwise think they would be. So there's lots of debate there. What's best, what's not. 100% EOT owned is the simplest. You don't have any mixed motivations because you haven't really got any one person thinking, oh, if we were to sell, I'd get to cash in on this. Everyone's just all on the same page. But so counter argument to that, with 100% EOT owned company, and let's assume from this perspective that the founder's been paid off, no one's got anything more to lose than their job if things fall apart. Equally, no one can make huge amounts if things go very well, because the EOT is all about sharing rewards across the whole team. So can be very nice, but a downside of that is imagine you've got one shining star who really holds that business together, and there's maybe 20 other staff working there who come in at 9, leave at 5, do their job, but they're not quite so critical. If that one shining star that takes all the stress and responsibility on their shoulders decides, you know what, I'm having a terrible month, the staff are all moaning, customers are being awkward, systems are breaking, I've had enough, I'm off, then potentially your business falls apart. So there can be an argument that those kinds of people need to be incentivized over and above the EOT, and them having some direct shareholding would do that. So if you're all founders in the room, you'll know what I mean by that in terms of I'm sure you've all had crappy weeks from time to time, but if you just walk away, you've lost all that value you've built up in that business. So again, by having someone with direct shares, it can leave them holding the baby, they call it, just so there's someone who really thinks, I can't just walk off, or if I do, I'm losing a lot here. Robin, do you want to chime in there?
Yeah, question. Can you arrange key person insurance for these types of critical staff? Replacement cost, some sort of a business continuity insurance?
I would assume so. I mean, I'm no expert on key person insurance, but I would have thought that was more for sort of illness, etc., rather than just if they decide to leave. But perhaps it could.
Because the question is, once you're in a scenario where you've got an employee-owned trust who owns a business and you've got equal ownership for all the employees, not everybody contributes equally in terms of value, skill set. Is everybody considered an equal party to the trust, the outcomes of the trust, firstly, and secondly, what do you do when people leave? What do you do when people join?
So on that final question, the EOT really makes it quite easy in terms of, no one owns anything in their own name. So again, maybe I should just clarify on that. With regards to the EOT's ownership, it's the trust that owns those shares. So the employees don't have any share certificates with their name on it. People can, of course, be paid different salaries. You may have some sort of commune-esque EOT companies where everyone's on the same salary, but I would say that's extremely rare. So you will still have what might be deemed a normal sort of hierarchical structure in that you've got the senior managers that are paid quite a lot, you've got the junior staff that are paid quite, modestly, and varying levels in between. And in terms of the profit share, again, let's just forget about the founder, the vendor for this perspective, pretend they're done and dusted. The profit share, you've got some flexibility on how that can be distributed amongst the team. You can do it if you work here, you get an equal split. You can do it based on hours worked, so full-timers get more than part-timers. You can do it based on length of service, so the people that have been with the firm for 20 years get more than the people who joined a year ago, or you can do it based on salary. So the last one obviously being the most skewed towards the senior people get the biggest share of profits. But yeah, I think especially at smaller businesses, I think it's important to have someone who has, you'll all have heard the phrase skin in the game, just a reason over and above their salary to get out of bed and make sure that the business keeps ticking over even in tough times.
So I guess what you're saying is that it's up to the trustees to decide the compensation and objectives formula for the business, and therefore distribute the profits according to that
Yes.
formula.
So the directors would still dictate salaries. You know, they'd be in charge of hiring and firing, that kind of thing. But in terms of how the profit share was split up, that would be the trustees that would make that decision.
Okay, so it's an interesting one. Thank you.
I mean, for what it's worth, in the sizes of businesses that we'll look at, the reality is that there's a bit of overlap between the two. You know, these tend to be smaller organisations, so it's not a case of you have the directors here and the trustees there, and they're, you know, not speaking and fighting each other. Quite often, there's a bit of overlap between the two. Yeah, Dan?
So yeah, what happens in the event that either somebody does, well, three things, does decide to leave after they've been obviously offered the shares and things like that, or part of the profits and so forth. The second thing is if they have to be made redundant because business operations need that to happen. And thirdly, if they get fired for whatever reason, what happens to the people in that, and what happens to their percentage of the profits and the shares and so forth after that?
Once they've left the business, they're not entitled to a future share of profits. The EOT doesn't really give them any more rights to their employment. So, you know, obviously you've got normal HR rules. You can't just willy-nilly fire someone who's been with the business for 5 years without very good reason. So, you know, if they're fired for gross misconduct, bang, they're out the door, end of. If they're made redundant, I mean, that's one of those tricky decisions where I think it would still be down to the directors legally to make that decision. But they might want the trustees on board. You know, theoretically, the directors are looking after the profits of the business. They're looking after the company. The trustees are looking after the needs of the employees. So there should, of course, be an enormous amount of overlap with that, but there will occasionally be situations where perhaps those are different. So you might have the directors saying, look, we're overstaffed in this department. We don't need these people. We need to get rid of some of them. And the trustees will need to be thinking, you know, not just we can't ever let anybody go. They need to be more mature than that. But we need to think, is this the right thing for the staff collectively? And it may be the case that if you've got 50 staff, 10 of them are now redundant in terms of what they do. Well, you need to get rid of them to help save the other 40 jobs. And does that answer your question, Dan?
Yes, it's basically no different to like a normal business operation. Then same sort of principles apply. It's no different rules or special rules because of the trustee nature of it.
Yes, and I think this is what's critical for founders to realise, because you know when it's your company, you know that no one can fire you. You're invincible. You're at the top. If you sell to an EOT, you can still remain the full-time managing director. But you need to be aware that you'll just be a high-paid senior employee, but there will be a mechanism by which you could be fired. Again, it's not easy to fire people. You need to have very good reason, etc., but it's possible.
Cool. Thanks very much.
Right, Kevin?
Hello, mate. You all right? Yeah, question for you. Just interested around, you talk about working at valuation, and you say it typically be done on like adjusted EBITDA. Is there any rules around adjustments? Because they say adjusted EBITDA can be quite different to cash EBITDA. So let's say you go, 3x multiple on adjusted EBITDA. I mean, it might mean you're making a tiny amount of cash actually in profit, but you're doing loads of add back, so it looks great adjusted, but it actually takes you forever to pay back that amount of cash because the actual cash generation you're going to pay back out is much smaller than the adjusted EBITDA figure. Is there any kind of guidelines or rules around what you can adjust on EBITDA when you do the valuation, or is there any kind of catches around that?
So there's certainly no rules, and this is why, you know, if I was to be cynical about some founders, there will be an attitude of, well, if I go off and get 5 people to value my business, whoever gives me the highest number, that is therefore the correct number, and I'll go with that. So a lot of it is very subjective, which I imagine is what you're alluding to. There's no getting around that. There's an argument that valuations are more art than science. I mean, you sort of made the point that perhaps you've got a business that's quite profitable, but not generating cash.
Cash generative, yeah.
So, I mean, I suppose in the short term, I can understand why that might be the case. But I guess longer term, I'm intrigued what might lead that to be the case.
Yeah, I mean, you'd expect like adjusted EBITDA doesn't last forever, you know, when you're adding stuff back, expenses and that kind of stuff. But if you do a valuation which is quite heavily inflated, because you can show, for instance, your EBITDA is 3 million, but in reality, you know, only generating 500,000 cash and those bits add backs. I just wonder if there's any kind of guidelines where when you work out the valuation, if you're going to be paid back out future cash profits, doing a valuation or a multiple based on an adjusted figure might just massively elongate that.
Well, yes, and from what you've just said there, you're making me think maybe you've been speaking to business brokers who perhaps, you know, they're no different to estate agents with a property. To win your business, they want to tell you that your business is worth the highest possible figure. So their adjustments will all be skewing things upwards. That shouldn't be the case. And, you know, well, kind of to come back, well, what's the whole point? How are you going to get paid? You're going to get paid out of not just future profits, but as you've kind of alluded to, cash that comes in. It's no good having hypothetical profits. So this is where, you know, if you end up, or your valuer ends up doing adjustments that are kind of artificially inflating the profits beyond what cash comes in, great, you can come up with a very high valuation figure, fine. Firstly, you're going to pay stamp duty on that. I mean, it's only 0.5%, so it's modest in percentage terms, but you pay that regardless of whether you end up getting paid for the actual proceeds. So if you end up with this, you know, I mean, this shouldn't happen. We're talking extreme and badly advised and also slightly aggressive founder here, but you end up with a way over the top valuation figure that you sell for. If the business is never going to make enough cash to pay that, you're never going to get paid it, so it's pointless.
Yeah, that's of course. I wonder if there's any sort of kind of standard guidelines or things to avoid around that if you're looking at doing EBITDA adjustments.
No. So I mean, you'll have different advisors that will tell you different things, and some of them will be quite polite and professional towards each other. Some of them will feel like, no, you're an absolute cowboy, I can't believe you do things that way. But at the end of the day, you know, that valuation will be done based on whatever metrics that valuer feels is appropriate. I probably can't say too much more than that. All right. So I've only got a few more little points I wanted to go through. Staff engagement. Now, this is something which is important to any business that has employees. You don't need to be employee owned for it to be important that the staff really care and the staff really want to push things forward. But it's something you'll hear hugely in the employee owned world, because the theory is you've sold to an EOT, right? All of the staff now collectively benefit from the future success of the business. So surely they will all care that much more to really work hard, be innovative, come up with ideas, act a bit entrepreneurial to really push that business. And I think sometimes some founders are a little bit disappointed that maybe 3 months post sale, not a lot's changed. The staff still come in, they do their job, they do as they're told, and they go home. And I think to some extent you just need to accept that. There will be people, and I'm not being critical of these people at all, where their work is not the most important thing in their life. You know, they've got family, friends, whatever that they're quite focused on. They come in, they do their job, they get paid, and they go home. Typically, if you set up a business, you are very work oriented. You will be thinking about it in evenings and weekends, potentially actually working on it evenings and weekends. So just don't have unrealistic expectations about your employees there. I would, however, say that I think what I've seen in practice is the staff will care a lot more about covering for each other and about having a go at slackers. Because picture a business with 20 staff and 2 of them, everyone knows they're dossers, right? But the business is owned by the founder. Those 2 staff that do very little aren't directly hurting the other staff. They're hurting the founder because you're paying them salaries and they're doing very little, but it doesn't impact the other staff. All of a sudden, staff start to twig, well, hold on, the business is paying this person's salary, which is reducing the profits, and we're sharing in the profits. So I think there's a risk it can get a bit Lord of the Flies. I don't think we tend to see that too much, but generally you see quite a sort of positive effect that the staff also know that if I want to slack a bit, I'm not helping that rich guy. So I'm not hurting that rich guy or woman at the top. I'm hurting all my peers. So I think there are reasons why productivity tends to be a little bit higher. Statistics do back this up, but it's not this magic. All of a sudden, everyone acts like an amazing entrepreneur the day after the sale. So I think key things are worth pointing out if you do proceed to do this with your business is to make sure the staff have realistic expectations of what's going to happen. None of them will be replacing you. If one of them wants to replace you, then they need to be looking at a management buyout where they put their hands in their own pockets or go to the bank and they personally buy you out. And in that situation, yes, it will then be their company. That individual will own it, or those few people. With an EOT, it won't change things like that. It will give them a little bit more power. It will give them a set in stone right to profits, but it will not give them ultimate control of anything. So in terms of what's required to do this, I think people are sometimes a bit surprised at how much paperwork there is to do. You know, because superficially you think like, well, those senior team are running the business anyway. All it is really changing shares from here to there. Yes, that's true, but it is a business sale. It does need to be taken seriously. So if you do want to proceed with it, talk with Kevin a bit about the valuation. You need to get an independent valuation. Since the budget, there is some concern that maybe there need to be 2 independent valuations. Because one of the new rules is basically that trustees need to, I can't remember the exact wording, but demonstrate that they've taken reasonable care to prove that they're not paying above market value for the shares. What does that mean? Well, it's very waffly and subjective, but I think one of the concerns can be that typically the founder, you know, the previous owner is the director of the company. They will be the one that goes out and finds an advisor. Even if that advisor legally is acting for the company rather than for the founder, if it's the founder that you're speaking to and the founder says, come on, my business is worth a bit more than that, come on, can you edge it up a little bit? Potentially to keep the customer happy, the valuer might be inclined to put that figure up a little bit. So can the trustees really rely on that as independent? My personal opinion, yes, they should be able to. If it's not an independent valuation, then that valuer shouldn't be doing it. And I don't really see it as a good solution to the problem to start to insist that, right, well, you know, the vendor needs to get their own independent advice. The buyer needs to get their own independent advice. Yes, there is an argument that's best practice, and I'm not disputing that argument. But what I am saying is at the smaller end of the market, apologies if some of you here have huge corporations, but I tend to deal with the smaller end of the market, maybe at 5 employees at the bottom end, perhaps 50 at the top end. Those kind of situations, there often isn't the money or the desire to spend the money to have 2 or 3 different sets of lawyers, corporate finance people, etc., involved. So you need to get that valuation done. Part of that will be a payment plan. So again, that alludes to what Kevin was talking about. It's all very well saying my company's worth this, but how are you actually going to get paid that? Business has to make profits to pay it. So you need to think, right, what are the realistic business profits? And by business profits, I guess I mean net cash inflows is perhaps a better word, because that's what you're going to be paid from. There will be a tax clearance process to go through, which, if I'm honest, you know, if you meet the criteria, it's a bit of a formality. I think the only reason why people do that is there is some subjectivity to some of these things. So I think the EOTs have, in rare occasions, been used for what might be deemed aggressive tax avoidance in the past. Some of these tweaks in the budget have been to reduce that. But yes, it's still deemed common sense to say, look, Joe Bloggs is looking to sell this amount of his shares for this much to an EOT. They're going to do it on this day. We're happy we meet these rules. Can you please confirm you're happy that, you know, you're not going to try and argue this is some convoluted tax avoidance scheme? But a bit of a formality. We've not had any issues with those. There will then be some significant legal documents with the sale. So if any of you have sold a business before, share purchase agreement you'll be familiar with, that's the biggie. There'll be various board minutes for the directors of the company to sign, and that will be both the trading company that's being sold and the EOT, which will be the buyer. There will be shareholders' resolutions, which again, sort of a geeky thing that sit alongside the board minutes, just for things that the shareholders are doing rather than the directors. There will be a trust deed. There'll be stock transfer forms, which is where you're selling your shares. So just be warned, there is quite a lot of paperwork involved. And then following that, there'll be a few submissions to HMRC. Stamp duty, like I say, yes, you get capital gains tax free, but you don't get out of the stamp duty. So there'll be 0.5% to pay. Very small in percentage terms, but it needs paying soon after sales, and it needs cash to pay it. So unlike you as founder, where you might be paid over a long period of time, that stamp duty needs to be paid immediately after sale. And there'll be a bunch of companies' house submissions. So you'll probably be familiar with persons of significant control. Assuming you're the founder, you will no longer be a person of significant control, or you might potentially be if you retained more than 25%. But the EOT will be taking over as the main PSC of the trading company. So that's it with regards to the sort of technical side of it. I set up GoEO with a view to helping make it more affordable and easier for those smaller businesses, so you don't have to spend tens and tens of thousands of pounds on the professional fees. So just, yeah, trying to make it a bit more of an off-the-shelf, easy to do thing. But yeah, I've realised we've had a few questions as we've gone through, but if there are any more, then I'd be very happy to answer them.